We've got a repricing going on in the United States. We have the UK governor saying we may have to raise rates sooner. We've got a repricing going on as far as Europe is concerned as well. All of these things are connected, and it's not just about the United States here, surely.
Absolutely. If you look at interest rate rises, really since the crisis, this is only the second time that we've had this global repricing, and that bonds have actually kept up with treasuries.
Yes.
So German bonds normally lag, UK gilts lag. Why are all interest rates rising? I actually think the inflation fear is a little overplayed. You don't see it in break-evens, you don't see it in tips. I think this is much more the great unwind, the QE unwind is getting priced in. The Fed taper wasn't a big deal because the ECB was still buying and the BOJ was buying. Well, that's unwinding, and I think the entire market is realizing that this decline in vol that came from QE, well, that's stepping away, and so we have to be ready for more vol.
Are you a little bit surprised that on a day like today, when the risk-off move is so sharp, the big macro fundamentals aside about where rates should go, that we're not seeing a more knee-jerk flight to treasuries?
I think some of the correlations are breaking down. Part of it is positioning, part of it is these exotic products. But also, when you get QE coming away, I think some of that correlation is naturally going to break. Interest rates will struggle to decline a whole lot more while equities can come off. So I think what you're seeing in the curve is interesting. The curve is steepening, which means that if I was nervous around equities, where do I park my money? Well, maybe it's not the 10-year or the 30-year, but maybe the 2-year looks safe. Because is the Fed really going to hike 4 or 5 times this year amidst all this volatility? Maybe not. So I think the front end has sort of found a ceiling in rates. The long end is not clear. If QE is going away, we could actually sell off a lot more.
Now, pre-financial crisis, I was in the financial markets at that point. We used to say that breakdown in correlations was healthy. You didn't have this sort of risk-on, risk-off sense in markets, and actually a breakdown of correlations was as it should be.
Yeah, well, we've been living in this new normal. Now we're going back to the old normal. I think the transition is difficult. Particularly, we've been in this reach for yield argument or carry trade for now almost 10 years. So how do you get carry? You buy long rates, you buy credit, you sell vol.
Yes.
All of these have to get unwound, and that could be difficult. I think it could create some random price action.
Is that what we're seeing here?
I think so.
You talk about this new normal. It'll be higher rates, higher volatility, but can it look like the old normal that we've seen before the crisis? Because we're starting from a lower base when it comes to interest rates. There's still QE in the system, even if it is being wound down. It's not gone away.
Right, yes. And I think R star, or what is equilibrium interest rate, I think there's a lot of research that maybe it is lower than where it was pre-crisis. So it's a good point. I'm talking about some move away from the last 8 years to, I don't know, some other normal, but it's probably not completely pre-crisis because look at productivity, look at demographics. We're not at where we were in 03, 04. I think the other thing we have to worry about is, are we late cycle? And if things do turn around, Congress is throwing a lot of money at the problem when we don't really have a problem. There's going to be not a lot of fiscal support here.
So we've just signed a tax overhaul in the United States, which is going to put pressure on the deficit. We're potentially going to see a vote at some point today on a budget proposal over the next 2 years is also going to add quite significantly to the deficit as well. Is that all part of this? Because there are so many events. We've seen that Treasury auctions are going to be significantly larger too.
Right. I think the Treasury made a very wise decision not to issue across the curve by a large amount, not to issue out the curve. I'm very glad they're not issuing 50-year bonds or 100-year bonds, because then the move in long rates would be a lot more.
You kind of had to figure that when everyone was saying, do 100-year bonds, that we were getting close to the bottom in rates, right?
That's a fair point, yes. I think Treasury said, look, hold on, we're issuing a lot of bills in front end.
So if this is a case about the end of QE, is this something that the ECB can or will respond to before its next meeting on March 8th?
I think that's the absolute key question, because for the ECB, growth is good. Global coordinated growth is happening. Inflation, I still think they're missing on the inflation mandate. Now, I think there's some resurgence in belief in the Phillips curve. They're probably going to look at the US and say, look, after a couple of years of growth, you do get inflation. And they seem to be worried about the euro, but the euro hasn't continued to strengthen. We think there'll be some pullback, depending on where we are market-wise on March 8th. I think Draghi will probably push back around too much of a pricing in of hikes, but I think central bankers all around are okay with a little bit of normalcy coming back to the market.
Let's talk very specifically about the macro backdrop, because as you say, you're skeptical of the boom in inflation story, and you don't think it's quite that compelling. So is the macro backdrop different, or is this a few data points here combined with the narrative of maybe central banks not easing anymore, spooking people? Like how different is right now versus, say, a year ago?
Right. I think inflation sort of changed a little bit of the fear around long-term interest rates. We went from the Fed is making a policy mistake. So 6 months ago, practically a lot of people I spoke to said this is a policy mistake, they should never be hiking, to now they are behind the curve. So I think the market does whip around. When you look at fundamentals of inflation, we are seeing a pickup, a very gradual pickup. I wouldn't take this 2.9 average hourly earnings to mean the next time we're going to 3.1 and 3.5, we're off to the races. There are structural factors, automation. I hate saying it, but the Amazon effect. I mean, there's a lot of other structural factors, demographics that you could argue will keep inflation from really taking off or making the Fed hike much faster than what's priced in.
So we always used to say that fixed income credit, whichever it was, led the rest of the market in terms of assessing what's going on and repricing it. Is that still going on? And what are clients saying to you, the fixed income clients that you talk to, saying about what we're seeing in equities and vice versa?
I think there's a lack of understanding on both sides to some extent, because fixed income investors will say, we knew QE was going to end and we thought rates were going to rise, and they've been rising since mid-December.
This is not new.
What happened suddenly last week? Was it really inflation? I think it's the fact that finally the long end caught up. For a long time, it was just front end repricing. When we got to 3 hikes this year, well, then the market started saying now the long end has to sell off, and that's what's hurting equities.
So coming into this year, we were talking about flatter curves, inverted curves at the middle of 2018.
No one's talking about that now.
Well,
that's true.
Could we still see it?
I think that requires a sudden growth slowdown where we have to realize that actually the Fed might be done. To me, and I was in the flattener really up until 2 weeks ago, and the reason I thought was the hiking cycle is about to be done. And then I see continued good growth, the tax momentum, better inflation. I'm thinking, no, this hiking cycle can actually last 2 years. Then the curve should not be this flat. So I think the curve is really a function of how far are you from the end of the cycle.